Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us here in the last Market Carver of April. So happy to be entering the warmer weather here finally in Indiana. I know several of you have had that all winter in Florida or Georgia or other nice places, but it sure is nice to see that turn happening here. So we've got three topics for you this week. I want to talk about the U.S. exposure within funds. Then we're going to take a look at business confidence and how that relates to spending plans. All right, jumping right in and taking a look at U.S. fund manager exposure. So Bank of America Merrill Lynch puts out this great survey where they take a look at fund exposures by the various fund managers, and it's a great source of information to see where they are positioned. Sometimes it can be a contrarian indicator when you see so many funds have lined up on one side of the aisle. There's very few left to go. Sometimes that works out, and other times you just see the very beginning of a trend. But either way, it's helpful to know where those exposures are. What we're showing on the screen here are the domestic versus international, and we have moved to a really steep difference between domestic and international as more and more fund managers want to move those assets overseas, something that we have seen just the beginning of. In fact, you go back many decades here and see it at a new low. Really, the last period that we had that was heavy international was in the early 2000s. So 2000 through the, say, 2008 up into the great financial crisis. Fund managers strongly preferred internationals as there was a long run of outperformance. And as you could see, back in that period, they got near these levels and they really stayed there for many years. So we wouldn't take this here as a contrarian indicator, just as that period provides a nice analog for how long these differences can stay out there when you're talking about a slow moving ship such as domestic versus international. So something that's had our eye for a good chunk of this year, as we shared with you several times here on the Market Carver, and this is just one angle of that. So I'm going to flip it back over to Andrew to dive into business confidence.
Thank you, Adam. So looking at this, the big theme so far this year has been tariffs. We've seen that's come across the headlines. Are they good? Are they bad? And we're not going to get political into the Market Carver, but we want to look at the impact they're having on corporate America as that flows over to how earnings growth are, and that's going to impact stock prices. In another recent survey done by Goldman Sachs, kind of keeping the theme of surveys for this week's Market Carver, was looking at corporate America business owners and the level of confidence they have with the amount of spending that they're going to be doing. Now, we initially saw this survey right after the election. We saw a big spike up. If you look at this chart here, you'll see that on the far right side, towards the end of 2024, you see that big move higher above the average. There was a lot of confidence, a lot of belief that with the new administration, there was going to be a lot of red tape cutting. It'd be very pro-business administration. And corporate America got really excited about that. Confidence really started to rise after the election. Then we roll into 2025 and we start getting a lot of the tariff announcements. And whether those will have positive or negative implications, what it does cause is uncertainty. And when you have uncertainty, business owners are less likely to start spending, growing, wanting to expand and put into investments in the areas that they're not sure what the landscape for the market or the economy will be over the next 6 to 12, 24 months. And so we are starting to see business confidence drop. Now, we had this conversation with the advisors on Monday in our weekly allocation call. The question was, okay, what's that mean? And so that's what the next chart we're going to show, again from Goldman Sachs, looking at, they did a study of when they start seeing uncertainty rise, when confidence begins to fall, what are the implications that can have on CapEx spending, about how businesses are investing. And what they're forecasting is when you start seeing this really big rise in uncertainty or confidence declining, that you start seeing spending decline. And this is the chart of their expectations that we've seen a positive over the last several quarters, positive in CapEx growth. And now as we forward into 2025 and out into 2026, they're expecting that growth is going to slow and outright contract as businesses really are uncertain and unsure of how they want to invest and how much CapEx spending they want to do because of the unknown impact they're going to have on their bottom line. And so this is just one of the most near-term implications of the tariffs and the announcements, as it's really providing a lot of uncertainty, clouding the forecast for a lot of companies and what their expectations for growth and earnings are going to be for this year and next. And we're seeing a lot of companies actually pull back on even making those types of forecasts, saying, normally we'll tell you, here's what we think we're going to do this year. Now they're saying, we're not really sure, we're not confident enough to give you that forecast, and kind of pulling those numbers back as they're really trying to manage the day-to-day in their businesses with each new announcement of either increase in tariffs, decrease in tariffs, and on it goes. And so this is causing then a little bit increase in volatility for the market. We're seeing big up days and big down days as the market's really trying to digest all of these headlines, all of this news, as well as corporate America trying to do the same as they run their businesses that are these publicly traded companies that we're trying to seek out opportunity and manage around. So it's a very interesting times, a lot going on, but this is one insight into how we're seeing the tariffs impacting today, as well as the confidence and the expectations for U.S. companies.
Yeah, very good, Andrew. And if you were at some of the third leads, we talked. There was recession questions, and we gave you our thoughts. And the primary thought is we don't want to be too precise. Economy is dynamic, and to really try to have precise odds doesn't really serve well. But we can have a general idea. And we talked about how coming into the year, recession odds were a little bit higher. And certainly over the last few weeks, they've undoubtedly ticked a little higher. Now, whether that's 50% or 60 or 40, it's somewhere in that neighborhood. And this is just, not great information, but something that is helpful to illustrate where we really are in the economy. And I think this is a strong factor, CapEx spending, that has tilted that just a little bit higher. So we also talked about those monthly jobs reports, and always a strong watch each month. Those will be critical to not see, starting to lose jobs at the same time. So we'll certainly be glued into that. And as always, making adjustments to your portfolio. We remain on defense with our risk barometer. So if we do continue to kind of have that type of trade on, we are prepared for it, and we'll be prepared to reverse course as those indicators change. So thank you very much for this time. If we can be of service, please give us a call, 800-928-4001, or scan the QR code and do it electronically. Thank you, and have a great weekend.